Welcome back to another episode of Daily Dose with Danny. Today we're going to talk about fully insured versus level funding your health insurance. Oftentimes you'll hear about fully insured versus self-funding. While this is great, not all companies can afford the risk of self-funding their insurance, especially small companies. And this is where level funding can come in and really make a difference for an employer group that has, let's say, 50 employees or less. Now, just as a refresher, fully insured, what is that? Well, that's kind of like renting your insurance, so to speak. It's a 100% fixed mechanism. You pay $500,000 in premium every year. That's what you pay. Doesn't matter how healthy of a group you are. If you use less of the insurance and you go seek healthcare a lot less than you were anticipated to, or it doesn't matter if you use it way more than you were expected to. Regardless of whether your year is quote unquote healthy or unhealthy, you pay $500,000 in premium per year, let's say. And another thing to note is that in the state of Florida, especially small groups, with a fully insured setup, you don't get any data whatsoever. You can't see where claims are going. You can't see, how much the urgent care is utilized versus the emergency room. You can't see hospitalization or anything. You can't see where your claims are going. This is where level funding can come in and really make a difference. I like to use the analogy of rent to buy, where like fully insured being renting, you're paying a monthly amount and you're getting nothing in return. Well, rent to buy, you're getting a little bit. You have a long-term strategy in place and you have the opportunity to see money back. I can't use, the term owning because I have to save that for true self-funding arrangements. But rent to buy is a great analogy as you have a long-term strategy. Level funding acts as a stepping stone for a self-funded arrangement. And this is partially fixed. So let's say 50% is fixed, 50% of your premium is variable. And so with the same example of using $500,000 a year, $250,000 in this quote unquote healthy arrangement, right? You've had a healthy year, $250,000 is fixed. So, it doesn't matter if you had a healthy year, you're paying that $250,000. But because you had a healthy year, and again, you're paying $500,000 in premium every year, you only had $150,000 worth of claims. Well, that's a total of $400,000 in premium, leaving $100,000 on the table. And so where does that $100,000 go? It goes back into your pocket as a surplus. That is level funding in a nutshell. And this all sounds great and dandy, but what happens when you have an unhealthy year, when you use your insurance as a group a lot more than you were anticipated to? You're still only paying $500,000 in premium, just like you were in the fully insured arrangement. This is because $250,000 is fixed, regardless of healthy or unhealthy year. The difference is in the variable costs, which are your claims. And in the unhealthy year, you paid $250,000 worth of claims. That $250,000 is out of your own pocket. Anything above that is no longer your responsibility. It almost can be viewed as a maximum out of pocket for an individual. Once you hit your max, you don't pay a dime anymore. This is the same with a level funded arrangement. Once you've hit the $500,000 where $250,000 is fixed and $250,000 is variable, you're off the hook for the remainder. And so in this instance, it's covered by stop loss insurance that you've been paying in your fixed costs below. So you are still only on the hook for $500,000. Another great perk of level funding is that you as the employer get access to your claims data. You can put together cost containment strategies to address these concerns so that way you can maximize your variable premium. For anyone that has questions about level funding, I'm happy to be a resource for you. I hope the video was helpful. Thanks again for watching. Bye.